We're going on now to finish off published accounts by looking at the kinds of notes that are requested in the questions. But I've added in as well notes that you could get on investments, quoted and unquoted, notes on dividends, and I've given a brief explanation on the accounting concepts that are required to be used in published accounts. So let's go through these four notes, the first one being the accounting policy on tangible fixed assets and stock. We separate them, do the tangible fixed assets first and then stock. And what you're required to explain really is, firstly, how you value the fixed assets and then how you intend to write them off over their expected life. So, in the first case, the vehicles were shown at cost, their original cost price. On the other hand, the buildings, although appearing in the trial balance at cost, were subsequently revalued at the end of the year, and it's the revalued figure you're showing in your balance sheet, so you have to say that. So, vehicles are shown at cost, and buildings were revalued at the end of 2012 and have been included in the accounts at their revalued amount. And then we go on to explain the depreciation. And the first sentence is a general comment on the purpose of depreciation. They say it's company policy to depreciate the tangible fixed assets in order to write off their cost or value over their estimated useful economic life. You'll notice there that they're not saying they're writing off the cost over their useful economic life, because in the case of the buildings from this year on, it's not going to be the cost, but it's going to be the revalued figure that will be relevant. So they explain to you that depreciation on vehicles has been 15% of cost, and buildings has been 2% straight line. Again, now look at the careful use of straight line here instead of cost, because of course from now on it's going to be 2% of the revalued figure rather than the original cost. The sentence explaining how you value stocks is really taken from accounting standards, and you're better off not using your own words to explain this. Stock is valued at the lower of cost and net realisable value on the first in, first out basis. If you were to go back and look at your operating profit, you'll see that, and there's no mention of what any of the costs or expenses were. And the companies actually require that the reader of the accounts is told what you've written off the fixed assets, how much you've paid your directors, and how much the auditor got out of the audit. Notice we're separating the so-called amortisation and payments. You're depreciating your tangible fixed assets. The 56,600 comprises two figures for vehicles and buildings, but there's no need to break that down. Directors' remuneration. Remuneration just refers to the various rewards that directors receive during the year. It would include directors' salaries for maybe the executive directors, the directors' fees for the non-executive, the guys who turn up at board meetings, and anything that the directors are paid, in fact. And one word, directors' remuneration. Remuneration will cover all of that. And then the audit fees. Given that the auditor is more or less the watchdog for the shareholders on the reliability of the accounts, how much did the audit cost? And how much did the auditor receive? The third note is on debentures and interest payable. The question required a note on interest payable, and in that case would be served by the first sentence. Interest is charged on debentures at a rate of 5% per annum, amounting to €10,000. The debentures you will see in the trial balance and your balance sheet for €200,000. That first sentence is sufficient to cover the note on interest payable. I've added the rest in the event that you were asked for a note on debentures rather than just debenture interest. So you'd explain that the debentures were secured by means of a fixed charge on the assets of the company. That means that assets have been used as security in the event of non-repayment of the loan or the interest by means of mortgaging some of the assets, probably the fixed assets. And then you're told also when the debentures are due for repayment. Now in this particular case there's a reference to 2017-18, which means they can be paid back any time within that period. The third note that was required was a note on tangible fixed assets. Now don't confuse that with note 1. Note 1 was a note on your accounting policies relating to tangible fixed assets and stock. Whereas this note here is explaining what happened to your fixed assets during the year. Not only does it become note 4, but it's also one of your workings so that you can find the 1,086,000 that will go into the balance sheet for the figure for tangible fixed assets. In this question we have land and buildings, and we have separately vehicles, and then we have a total column. And we're breaking it into 3 bits. The asset values and what happened to those assets during the year, so that we started off with 950,000 worth of buildings at cost. The question told us that we got rid of land worth that cost 70,000. And then we also increased the value of the buildings up to 970,000. So to do that, you see, we have 950 less 70 is 880. And to get from 880 up to 970, we had to increase their value by 90,000. Hence the plus 90,000 there. Then, in relation to depreciation, we started off here with a provision for depreciation balance, or accumulated depreciation for buildings of 50,500. That's your trial balance figure. The charge for you was 17,600. And of course, once we revalued the buildings at the end of the year, we had to transfer all of the depreciation written off already, which was the sum of those 2 figures. So 68,100 got transferred, leaving us with a 0 value of depreciation at the end of the year. So that when we're doing our balance sheet, we have the revalued figure of 970,000 less 0 depreciation, giving us 970,000. Meanwhile, in vehicles, we started off with vehicles that cost 460,000. There were no additions or disposals or revaluations, of course. We started off with €105,000 worth of depreciation already written off. That's our opening balance in the provision for depreciation account, our accumulated depreciation. The 39,000 or 15% of cost was the depreciation written off during the year. That brought us up to 144,000. So if we're to take 144,000 from 260, we have 116,000 as our net book value at the end of the year here. So we have 970 for land and buildings, and we have 116 for vehicles, the sum of which is the 1,086,000. You'll notice that I have the opening balances as well at the start of the year, because of course the Companies Act require the previous year's figures as well, and that's what's going on there. From a marking scheme point of view, you really do have to present all of these figures, because you don't know which of those are going to be selected as the ones required by the marking scheme. Typically 6 of those figures will be ticked at maybe a half mark each. A lot of work going into this, but it's very important to get it right. Notes on investments. Now in this particular case, the company has, I think, 4% investments or something like that. But they have investments at a cost of 300,000, and we're not told what they're worth now. Previous questions had both quoted investments and unquoted investments, so I want to make a reference to that. The Companies Act require that where you have quoted investments, that you say what their value was on the balance sheet date. Quoted investments typically would be where the company or company whose accounts we're doing would have invested in other companies with stock exchange quotations, or maybe government bonds or something like that. That would mean then that the market price of those investments is readily available. They're published twice daily by the stock exchange, so it's only a matter of looking up what the values were on the balance sheet date. From your point of view in an exam, they would have given somewhere the market value for the quoted investments. In this note, you'll say the market value of the quoted investments on the balance sheet date was whatever the value is, and you need say no more. Remember, of course, that you always enter the investments at their original cost. don't be tempted to put them into the balance sheet at their market value. And then in the case of unquoted investments, there is no stock market quotation that can be referred to. This would be where the company maybe has bought shares in maybe public companies without stock exchange quotations, or maybe the shares of private companies. So what you've got to give in that case, where there's no objective outside quoted price, you've got to give the director's opinion as to the value of the market value of those investments. So in the case of unquoted investments, it is the opinion of the directors that they have a market value of whatever number of euro on the balance sheet date, and that's it. We'll go on now to look at the note on dividends. You remember in your P&L appropriation account that you had dividends of 50,000. And now we've got to break this down in the note. I know it's 9,000 preference dividend because in the trial balance you say they have 150,000 euro worth of preference shares, and they're 6% preference shares, and they're €1 shares. So I know that the preference dividend paid so must have been 9,000. And that's 6 cents a share, 6% of €1. That means that the remainder of the 50,000, 41,000, applies to the ordinary dividend paid. And then I've divided that 41,000 by the 500,000 ordinary shares that have been issued, and that's where I'm getting the 8.2 cents. The dividend note is much shorter nowadays because there's no more dividend proposed, just dividends paid. Finally, I want to have just a reference to the accounting concepts that you're required to apply when doing the published accounts. Now, in your accounting course, you will meet lots of accounting concepts, but these are the only 4 required by law to be applied when you're doing the published accounts. There's going concern, accruals, prudence and consistency. And they must be applied when doing the published accounts and balance sheet. That's come up once or twice in previous questions where you've been asked to mention some of the obligatory or compulsory or required accounting concepts and to explain maybe 2 of them or something like that. The going concern concept says that the reader of the account and balance sheet is entitled to assume that the company is going to be here this time next year, because that does influence asset values like things like plant and machinery and stock, which would have much lower values if the firm weren't going to be continuing on into the near future. The accruals concept, or the matching concept, would be the idea that in your accounts you show not just the amounts paid and received, but that you put in everything that belongs to the year, whether paid or received or not. The prudence principle would be the concept of conservatism or prudence, the idea that you always allow for a loss if you expect to make one, but you never allow for a profit until you actually make it. And the consistency concept would refer to the idea that whatever policies you apply in one year, you should be applying them in all years unless you've got a very strong reason for changing. So that, for example, if you're using straight line depreciation on buildings, there's no reason why you should change it to reducing balance the following year. If you're using reducing balance on your motor vehicles or something like that, again, there's no reason for changing it to straight line in the next year. And if you're using first in, first out valuation for stock, there's no reason to use a simple average the next year. Maintain the same accounting policies or bases from year to year. That's what consistency would mean. There are many other important accounting concepts like double entry or entity or realisation and these things, but they're not legally required, whereas those 4 are when applied to published accounts.